Good morning, ladies and gentlemen. On behalf of the Czech National Bank, let me welcome you to its quarterly meeting with analysts to discuss yesterday's monetary policy decision of the Czech National Bank's board and also to present you a new macroeconomic forecast. First, I'd like to ask you to mute yourselves unless you are given the floor. Should you want to ask a question, please use the chat function in the WebEx application. You can either signal that you want to raise a question, or you can send me the whole question and let me read it on your behalf. Now let's move to introducing our speakers. Today they are Czech National Bank Deputy Governor Marek Mora, Executive Director of the Monetary Department Petr Král.
Hello to everyone.
Deputy Executive Director of the same department Luboš Komárek.
Hello.
And Macroeconomic Forecasting Division Director Karel Musel.
Good morning to everybody.
As always, we shall start with our new quarterly forecast, which will be today presented to you by Luboš Komárek. Luboš is located in a separate room to be able to speak without a face mask. Luboš, over to you.
Thank you very much, Markéta. Still very good morning, ladies and gentlemen. It's my privilege to present our May monetary policy report today, which is still significantly, as you know, affected by the coronavirus pandemic. The outline of my roughly 30 minutes long presentation is the following. I will start with the assumptions of the forecast, then move to the core part of this presentation. It means to our new macroeconomic forecast. The third part compares our new forecast with the previous one prepared during the winter. In the subsequent two parts, I will present longer-lasting pandemic scenario and then two monetary policy simulations. The first assumption of forecast is related to the external environment outlook. As you can see from the charts on the left, optimistic GDP growth in the effective euro area will resume during the year owing to growing vaccination coverage and reopening economies. The European economy will return to its potential output level over the forecast horizon. It means, as you can see from the top right panel, the negative output gap will gradually close. The pressures on PPI will strengthen considerably this year. In addition to growth in prices of oil and other commodities, stronger demand for industrial goods will have inflationary effects. Finally, from the bottom left panel, we can see that the 3 months Euribor outlook remains negative. The effects of unconventional monetary policy on the shadow interest rate is gradually diminishing. Okay. The second assumption of our forecast is related to the domestic pandemic situation. As you can see from the top chart, after peaking in March, the stringency index started to decline and will continue to do so for the rest of this year. However, the restrictions during this spring and summer will be rather greater than last year. I would like also mention that the direct economic impacts of the fight against the pandemic were smaller in the first quarter than in spring last year, even though the stringency index has been higher so far this year than a year earlier. Czech government anti-epidemic measures are mainly affecting wholesale, retail and services, while industry has hardly been affected by the administrative restrictions at all. The third assumption of our forecast concerns the development of domestic fiscal policy. As is clear from the top chart, government consumption will continue to rise this year on average, albeit more slowly due to last year's high expenditure. Following last year's exceptionally high contribution of fiscal policy to GDP growth, this year's fiscal impulse, which is displayed in the lower panel, is also forecast to be strongly positive. Our spring forecast also contains additional measures approved on an ongoing basis to support households and firms in response to the continuing pandemic. The second part of my presentation is the main part, consisting of the baseline scenario of our new macroeconomic forecast. I start with the development of the most important variable for the Czech National Bank, which is, of course, the headline and monetary relevant inflation. Following its recent drop close to the 2% inflation target, inflation will rise back towards 3%. It means towards the upper boundary of the tolerance band in the quarters ahead. This will be due initially to a sharp increase in food prices. Later, however, food prices will start to rise significantly again, and administrative prices will also begin to go up at the end of the year. All this will be going on amid only gradually falling core inflation. Inflation will return close to the target next year, aided by a gradual decrease in the expansionary nature of the monetary conditions. Our headline inflation will be slightly above monetary policy relevant inflation owing to a rise excise duties. This you can see from the bottom chart. In this slide, you can see the main components of domestic inflation. Domestic demand in the Czech Republic will start to manifest itself in upward price pressures. Together with renewed growth in PPI abroad, this will slow the decline in core inflation. And this is clear from the top left panel. A surge in year-on-year growth in fuel prices, which you can see from the bottom right panel, reflects both last year's low base and the recent sharp rise in all prices. Growth in food prices will pick up substantially in the second half of the year. This will be mainly due to growth in global agriculture commodity prices. And finally, administrative prices inflation will be muted for most of the year, but will start to rise sharply in the autumn as the temporary decrease in energy prices subsides. This chart demonstrates inflation pressures from costs in the consumer sector. As you can see from the chart, the overall inflation pressures will gradually ease this year, which is visible from the development of the black line in this chart, as both components of import prices turn from inflationary to anti-inflationary. I would also add that growth in costs will then stabilize near its steady-state level, with the domestic economy making the dominant contribution. I would like to add that initial positive contribution of the energy component, and you can see this in gray columns, to grow in cost is linked with the surge in all prices. Despite the anti-inflationary effects of significant appreciation of the koruna, the contribution of core import prices, which is visible in red columns, will initially have a broadly neutral effects on growth in total costs. The main reasons are the solid growth in core foreign prices this year, and the second reason is the observed rise in agriculture commodity prices. This chart also demonstrates inflation pressures, but this time from costs in the intermediate goods sector. Again, as you can see, growth in domestic costs remains subdued at the turn of the year and will stay low during the spring months, mainly due to the gradual cooling of the labor market. This is visible from the development of the yellow line in this chart. Growth in domestic costs will start to pick up in the middle of this year on the back of sharp rise in domestic demand, captured by the contribution of the price of capital, and this is visible in gray columns. The economic recovery will foster a gradual increase in the contribution of wages, which are visible in green columns. However, the inflation pressures from the domestic economy will be damped to a large extent by improving labor efficiency, blue columns, due to people returning to their workplaces after the shutdowns in services and retail end. We expect that growth in domestic cost will stabilize close to its steady-state level next year, as you also can see from this chart. Now, I shall move to a description of labor market in the Czech Republic. The chart at the top presents the development of employment and unemployment. As you can see, the decline in employment, which is visible in this blue line, will be due mainly to services in market sectors such as hotels and restaurants. The decrease in employment in industry will fade out in mid-2021 due to a recovery in external demand. The general unemployment rate will rise until the second half of this year, despite government support measures and still solid labor demand. See the development of the red line in this chart. Fundamental wage growth, visible in the bottom chart, and this is this yellow line, will initially slow further and then start to recover gradually at the end of this year, while wage growth in non-market sectors, which is here in red, will slow sharply this year. Okay. The GDP forecast of our spring prediction is visible in this chart. We expect that economic activity will recover in the second half of the year as retail and services reopen and industry begins to run smoothly again. As you can see from the bottom chart and the red columns, household consumption will be a main driver of growth next year. To summarize, according to our new forecast, the Czech economy will grow by more than 1% this year, and in 2022, GDP growth will exceed 4%. Besides government shutdowns, the production performance of the domestic economy is currently suffering due to problems with supplies of materials because of overloaded global supply chains. As you know, this will lead to the next export making a negative contribution to GDP growth in the first half of this year. We expect these global supply chain issues to disappear and exports and industry to recover in the second half of the year. For example, the Škoda car company is also affected by this issue now. Household postponed consumption and forced savings were among the main issues of this spring prediction round. Forced savings exist due to the inability to spend on consumption during shutdowns, account for the bulk of additional household savings. We expect that part of forced savings will be used for deferred or, let's say, additional consumption, from the middle of this year. In the second half of this year, consumption will pick up due to the return of individual sectors to normal, as shown by the contribution of the pandemic. By contrast, the fiscal impulse, as previously discussed, will begin to dampen household consumption growth. In the following chart, we can see the recent history and forecast for all four components of aggregate demand. As the economy reopens, let's say consumption-hungry households will begin to return to their usual shopping habits and will also realize part of their previously involuntary deferred consumption during summer. Development of consumption is clear from the top left panel. The top right panel shows growth in private investment activity, which will not recover until the second half of this year, while government investment will rise steadily over the entire forecast horizon. The bubble in industry will be reflected at first in muted growth in exports of goods and services, which, however, will recover significantly in the second half of the year. And finally, imports are being affected by domestic shutdowns and will recover with domestic activity. One of the most important variables for the small economy is, of course, the development of the exchange rate. Crucial for the Czech Republic especially is the exchange rate of the Czech koruna against the euro. From our fund chart for the koruna-euro exchange rate, you can see that the koruna will appreciate further. It means that fade out of the temporary bubble in industry and the slow reopening of the economy, coupled with gradual growth in vaccination coverage, will lead to further appreciation, which is visible from this chart. This will also be fostered by widening interest rate differential vis-à-vis the euro area due to a rise in domestic market rates. The exchange rate will thus appreciate slightly beyond 25 Czech koruna against the euro by the end of the next year. The final fund chart, as you can see from this slide, shows the interest rate path for 3 months PRIBOR. It's very clear that consistent with the forecast is stability of market interest rates initially, followed by a rise in rates from roughly the middle of this year onwards. The initial stability of market interest rates reflects a continued need for easy monetary policy responding to the impacts of the pandemic and government epidemic restrictions. I would like to add that solid price pressures from the domestic and foreign economy will require an increase in market interest rates in the second half of this year to stabilize inflation close to the Czech National Bank 2% target. The third part of my presentation traditionally compares our new forecast with the previous one. It means with our winter forecast. These slides show the basic comparison of our spring and winter forecast, as I already said. As you can see from the top left panel, the upward revision of the inflation forecast this year is due to all its components except administrative prices, whose growth remains temporarily subdued. The GDP forecast for this year has been revised downwards due to the longer duration of the pandemic and the bubble in industry recorded in the first half of this year. This you can see from the top right panel. The revision to the average yearly wage growth is clear from bottom left panel. This revision is linked mostly with statistical effects. The last chart shows that In the near term, the slightly stronger exchange rate of the koruna mainly reflects the rate observed 3 weeks ago. It means in mid-April. The subsequent more moderate appreciation reflects the outlook for a more gradual domestic recovery. In this slide, I will compare our new interest rate forecast with the previous one. It means with the winter one. As is clear from the top chart, the interest rate path is initially similar to that in the previous forecast, but shifts slightly higher next year. The composition of the 3 months PRIBOR is presented in the bottom chart. As you know, a temporarily worse domestic economic outlook is reflected in an initial negative contribution of the initial conditions plus GDP plus wages category. This is this dark blue columns in this chart. While the recovery of the Czech economy is more pronounced next year and leads to higher rates. As already discussed, the fiscal impulse, this is here in violet columns, temporarily fosters slightly higher rates. Unlike in the previous forecast, it is expansionary this year. External developments, especially the outlook for somewhat less accommodative ECB monetary policy, coupled with higher oil price, foster slightly higher domestic rates. And you can see the development of shadow columns in this chart. The penultimate part of my presentation describes the longer-lasting pandemic scenario. By means of this slide, I would like to describe the external assumptions of our longer-lasting pandemic scenario, which, for your information, was prepared by means of a NIGEM model. This scenario leads to a markedly slower economic recovery in the euro area than in the baseline scenario. This is clear from the top left panel. The decline in GDP mainly reflects a decrease in potential output due to the longer-lasting shutdowns. However, it will also be reflected to a lesser extent in the output gap opening into more negative territory. This you can see from top right panel. The result is more subdued overall PPI inflation, which will stagnate in next year, see bottom left panel. Finally, longer-lasting anti-inflationary demand effects are consistent with a further easing of monetary conditions by the ECB, let's say using an unspecified combination of instruments, conventional and unconventional one, which will be reflected in a drop in shadow interest rate relative to the baseline. This is visible from the last panel. In this slide, I would like to illustrate the results of this longer-lasting pandemic scenario for the domestic economy. The weaker external demand coupled with the stronger domestic cyclical impacts of the more gradually receding pandemic will result in substantially slower growth of the Czech economy. This you can see from the top left panel. The more negative foreign output gap over the entire outlook fosters a weaker koruna via lower demand for Czech exports, and this you can see from the bottom left panel. The lower demand for domestic production and slower wage growth will foster more subdued overall inflation pressures and a need to increase interest rates later than in the baseline scenario, as you can see from the charts on the right. It means interest rates will therefore not be raised until the start of next year in this scenario. The easier monetary conditions than in the baseline scenario will ensure that inflation will be close to the inflation target at the monetary policy horizon. And the final part of my presentation describes monetary policy simulations. In this prediction route, we prepared two monetary policy simulations. The first simulation, the yellow line, describes the situation where the interest rate stayed unchanged until the end of this year, while the assumption and path of the baseline scenario, this is this blue line, materialize. It results in distinctly higher inflation, as you can see, which will markedly exceed the upper boundary of the tolerance band, 3%, around the inflation target at the end of this year. The second simulation, and this is this red line, captures the situation where the longer-lasting pandemic scenario materializes, but interest rates rise in the second half of this year in line with the baseline scenario. And this is the blue line in this all charts. It results in inflation falling below the inflation target, albeit within the bounds of the tolerance target. And now I would like to only thank you for your attention. I trust that these special pandemic restrictions have not reduced the value within you normally receive from your or from our face-to-face presentation in the Czech National Bank. And I now give the floor back to spokesperson of the Czech National Bank, Markéta Fischerová. Thank you very much.
Thank you, Luboš, for the presentation. Now we can turn to the Q&A part. Do we have the first question, please? Well, it looks as if we might need to break the ice. So I have a question for Marek Mora. Marek, how would you describe the bank board's discussion yesterday about the timing of future rate increases?
So good morning once again from my side. Let's hope that our next meeting will happen physically. At least the situation is developing in such a direction that the probability of this to happen is increasing, but of course we will have to see. Now, to Markéta's question, I think the board yesterday received quite positively, or quite well, the new forecast from our monetary department. We more or less all aligned to it, and we agree that, or we see that consistent with this forecast is also the increase in the interest rate roughly as from the second half of the year. So we accepted that, but of course the exact timing, how and when we will begin the way back to, let's say, more normal policy rates will depend on the situation. But I think our alignment of the board with the forecast was quite high, and I think everyone can see and read the trajectory, and I will not speculate anymore about it.
Okay, thank you, Marek. And there is a question from Rafaela Tenconi. Rafaela, do you want to pose the question on your own?
Hi, good morning. Sure. I was wondering, what is the assessment of the members with regards to lending activity, so both households and commercial lending, and also separately and related to that about real estate prices? since I am thinking about whether you think real estate prices in the economy as a whole are at a level that is concerning, and is the correction potentially through higher interest rates is something that you are already thinking about? Thank you.
Yeah, thank you for the question. I must say that there was not much of the discussion about lending yesterday in our board meeting. Of course, we watched these data very carefully. We are aware of the development, but we also try always to split our decision-making in two parts. Yesterday, we had our monetary policy meeting where we try really to target our consumption inflation. But these considerations which you mentioned, and which are important, of course, and maybe even more important in the Czech Republic, and we are fully aware of it, but this is, in our view, more linked to our decision-making in the area of financial stability. And let me maybe then turn your attention to our meeting, which will happen, I think, in the last week of May, when we will discuss financial stability issues, where exactly this will be definitely one of the main points of our discussion. So yesterday it was not discussed much. Generally, the lending was not a big part of our discussion. We somehow maybe mentioned the real estate prices, but as I said, we concentrated on the consumption inflation, and we of course are aware of the fact that if we start normalizing or increasing our policy rates, this will also go in the same direction as you mentioned, in the direction of possible cooling off also of the real estate market. But this remains to be seen. And let me also say that the interest rates in the area of the real estate lending are already, in my view, affected quite significantly by the longer end of the yield curve, which has changed to some extent, maybe also due to our previous communication, but I would say it has changed mainly due to the development in the international financial markets, and we already saw some increases there. But as I said, this topic was not a big part or not much of our discussion yesterday.
Thank you. If I can squeeze in a quick follow-up. Would I be interpreting the presentation correctly if I say that by the end of 2022, you expect interest rates to be around the neutral rate for the economy?
Look, I think it would be probably too much to say at this point of time. We have the trajectory, but we have 4 forecasts per year, so we are continuously adjusting to the situation. From the current point of view, theoretically, this could be fine, but if in reality we will get there or not, we will see. And definitely it is not a commitment of the board or any kind of forward guidance that we will move to this direction. But Petr Král will want to say something more about it.
I completely agree with Marek, but I would like just to remind you of the fact that the policy neutral rate, estimated and consistent with our core model, is set at 3%, which is 1% real interest rate equilibrium plus 2% inflation target. And we are approaching 2 at the end of next year, looking at the particular graph in the presentation.
Thank you.
Thank you too. And the next question comes from Agata Urbanska-Giner at HSBC Bank. Agata, the floor is yours.
Thank you very much. Good morning, and thank you for this presentation. A quick question from me. Can I ask about the monetary policy scenarios? They are extremely interesting, very exhaustive. I want to ask about Bank's board opinion and perception about those scenarios and their findings. So does the board agree broadly with the conclusions that are offered by those 2 scenarios, which in my thinking means that at the moment delaying hikes until end 2021 would cost overshooting inflation significantly, whereas potential early tightening, even if this negative scenario of longer pandemic exists, doesn't mean that inflation declines excessively. Does the board agree with those conclusions? Thank you.
Thank you for your question. Let me maybe now just to make clear one thing. We have one alternative or one scenario, which is a scenario of longer lasting pandemic. So this is really a scenario. This, what you probably have in mind, are these two simulations which we made at the very end and which Luboš presented at the very end. I think, I hope at least I interpret it correctly. We took note of this. We of course, it helped us to weigh up all risks. You know, the risk that we might overshoot our inflation target, to which, of course, we remain committed, but also the risk that we might make a mistake if we increase rates too early and the situation would develop in such a way that it would go in the way of the longer-lasting pandemic scenario, that this would be a mistake. So we discuss both of these things, and I think I can say at this stage that the perception of the board became, let's say, a bit more symmetric between these two things. Before, we more inclined, or we thought that the risk of longer-lasting pandemic was greater. Now we think that the risk is still there. You know, if we sat here a year ago in May, which was the end of the first wave of the pandemic, no one probably expected at that time that we would have such a horrible year before us as we spent in the last year. So one can never exclude that another kind of black swan will come. But now we have a different situation. We have a vaccine. We have some progress also in the medicaments on COVID. So we are aware of this risk, but we also think that the risk of overshooting our inflation target and maybe losing a bit of our credibility is there as well. So as I say, I think these two perceptions became more symmetric in the meeting yesterday. I don't know if colleagues want. No.
Thank you.
And now I'm giving a floor to Maidoan, an economist at Merrill Lynch, Bank of America Merrill Lynch.
Thank you very much, Markéta. Good morning. Thank you very much, Mr. Mora and Mr. Komrak, for your presentation. I would like to ask a bit more elaboration from your presentation. It was a bit fast, so I couldn't figure out very accurately on the wage dynamics. So you say that there's some technical adjustment in the wages, and following the Q4 number, which was quite a big surprise in nominal wage growth. Can you elaborate a bit more on the dynamics you see here in the labor market and your sense of what is the risk going forward in terms of, to your forecast? Is it upside or downside? You have any sense at the moment? I made another question to the Deputy Governor, Mr. Mora, on the feeling from the board yesterday when we heard the comments from Governor Rusno about at least one rate hike this year. Can you give us a bit of the sense from the board about the kind of trigger or the kind of timing that you may watch out for to deliver the first hike? Thank you very much.
If I may ask Luboš to put slide number 42 for the screen. Because the considerations and outlooks for nominal wage growth in the business sector is substantially affected by one-off and statistical effects that complicate understanding the actual developments and which are making the actual year-on-year growth path very volatile over the years. That's why we compute this fundamental wage, which is excluding those one-off and statistical factors such as the effect of furlough arrangements and care benefit drawdown, etc., including extra bonuses paid to workers in healthcare sector, and we compute this fundamental wage and fundamental wage growth, which is consistent with the overall assessment of the labor market situation as we analyze it, and we can say that the labor market has been gradually calming down following the last year's deep decline in economic activity, but the situation on the labor market is not as bad as one might have expected before because of the two things. The first one is the substantial financial support of the government via job rotation schemes, etc., to preserve the existing employment in the industries and firms directly or indirectly affected by the coronavirus pandemic and closures of the economy. And second thing is that the labor market is very flexible, and people who were fired can easily find a new job in the manufacturing sector, which is still reporting very high numbers of vacancies, and that's why people can easily find a new job if they want. That's why the rate of unemployment has risen only mildly, I would say, until now, and we can expect some further increase in the unemployment rate, but the peak of this trend will be relatively mild, and further we can expect some turnover in the labor market as the economy will be reopened and service sector will start to functioning again. And that's why the nominal wage growth in the business sector, after adjusting for those one-off and extraordinary effects, will gradually decline further, but this decline will not be any steep, and it will stabilize further later on, and as we were approaching the end of this year, we can expect some mild acceleration of nominal wage growth in the business sector. When compared to the new forecast with the previous one, there is only marginal change, reflecting the latest available data, making the new forecast being slightly above the previous one, if I am not mistaken, Karen. Yeah.
Now, on your second part, do you want to say something more? On your second part, on the second part of your question, when you referred to the statement of Governor Rusnok in yesterday's press conference that you said, I think, and I hope I will not misinterpret it, that there will be at least one hike by the end of this year, and what has brought the board, what was the atmosphere in the board. Let me maybe start a bit broadly. Very roughly, if I may say, our basic story, which we basically presented, I think, in autumn last year, was that one day there will be an end of this horrible COVID saga, mainly linked probably to vaccination. Once vaccination is effective, it will allow opening the economies. Once the economies are open, there will be a revival of economic activity, which will create some inflationary pressure, to which we will have to react in a forward-looking manner with our monetary policy instrument. This is basically the story, and I think we haven't changed it, I think, at the latest, at least from November or from autumn last year. And we are basically keeping this story. Now we see that this story is getting more and more confirmed, if I may say so. So we have less and less uncertainty about this COVID-related measures by the government, or there would be new risk. Of course, we are aware that there could be a new, let's say, black swan linked to COVID, and that's why we also asked our staff to prepare this scenario. But all in all, as I said before, our perception of risks became more balanced, and we also see more and more these inflationary risk. I mean, there are more and more signals going in the direction of higher inflation. We have to take these into account as well. Don't forget that our inflation for the whole period since COVID started never went below our 2% target. Maybe 1 month we were at 1.9, if I am not, or somewhere very close to 2. So we don't have a problem with too low inflation, and when we see this multiplication of signals which go in the direction of higher inflation, and if we weigh them up together with the potential risks that something in the end could get wrong, also in the COVID area, that let's say the vaccination in the autumn will turn out not to be effective against, I don't know, whatever mutation of the virus, which cannot be excluded. So, but we have to weigh up all these risks, and that's why we now got a bit more inclined to agree with the trajectory as presented by our forecast. This is basically the logic of our thinking.
Very much.
And now, Jose Cerveira from JP Morgan wants to join the discussion. Jose, please feel free to ask your question.
Hi. Hi, good morning, everyone. Thanks for the presentation. I have 2 questions, if possible. So one a bit more on the technical side, on the forecast. Could you comment a bit on the increase in forecast for core inflation? So between the second quarter and the fourth quarter of this year, the forecast is lifted by 0.8, roughly. I understand that the starting point is a bit higher, so the core was a bit higher in Q1 than what you had, around 0.3. But what explains the rest of the lift? Is it just the imported PPI bit? And if so, could you confirm if that imported PPI includes like metals and that kind of, and other commodities, or is it a sort of core PPI measure? So is it more about that, or is it something else? Because also the growth picture is revised to the downside, consumption is revised to the downside this year. So what explains the lift in core CPI near term? So that would be my first question. And then if I may, a broader question, and I'm happy for both the monetary department and Mr. Moore to comment, how to think about, it's a broader question, how to think about a world in which the Fed has signaled that it will tolerate inflation overshoots and hence will have lower rates than it would have had otherwise, a world where the ECB is also likely to have very accommodative policy for a long time. So in this world, the Czech National Bank will be hiking to 1.75 by the end of next year. If we take the forecast as a baseline, should we be concerned about the currency overshooting what the baseline is in this forecast against this world background? And I would also care for your thoughts on the difference between the previous cycle, where we had the factor of the overboughtness, as you called it, of the Czech crown back then in the aftermath of the peg. And right now we don't really have that. I think probably the market is still long Czech crown, but not to that extent. So isn't it easier now for the Czech crown to overreact to a CNB that would be probably one of the very few central banks tightening? So sorry if it's a bit long for me, but if you could comment, I would really appreciate. Thank you.
As for the first question, I would like to turn your attention to the fact that we somewhat reassessed or adjusted the assessment of the cyclical position of both foreign and domestic economies when compared to the previous forecast. Today, we incline to believe that last year and this year economic decline was more attributable to the decline in the potential output rather than to the opening of the negative output gap. The negative output gap was opening to some extent, but the magnitude of this opening is in the current forecast milder compared to the previous one, and this applies to both domestic and foreign economy. And this is making some less anti-inflationary pressures on the domestic price indices, including and especially related to the core inflation segment. This story is underpinned by the fact that we can identify that the global industrial sector is overburdened or overstretched by the increased demand of people for industrial goods, which they demand as they cannot spend money for a non-tradable sector, which is under closures, and second, which make them more happy to spend time under lockdowns in many countries around the globe. That's why we see that the world industrial sector is not able to smoothly react to the increased demand for industrial consumer goods, and there are some bottlenecks around the globe that are showing that this sector has got to some limits, and prices of certain parts of global value chains are growing. This is the story not about the information and communication technologies, but also the story about household equipment, the story about leisure equipment, etc. And this is in our forecasting model represented by the core segment of foreign PPI in the euro area, which has been rising quite sharply in recent months, and this factor is pushing domestic core inflation upwards compared to the previous forecast. The second argument is related to the domestic situation. We can expect that following the quite solid situation in the labor market, and following the fact that people have saved a non-negligible amount of money by the fact that they cannot spend them during the lockdown, this part of enforced savings will get back to the market and will support the renewal growth in consumer spending after the economy is reopened. And producers and retailers and service providers will utilize this situation by increasing their profit margins and by trying to make up for missing revenues from the situation where the economy was closed. That's why we increased the core inflation forecast somewhat during the next couple of months and quarters, which is reflecting the overall more pro-inflationary picture we can attribute to the observed domestic and foreign economic developments.
So let me continue, and I hope that Petra survived well our small accident here with the banner. You can see that the banner of the Czech National Bank is an important thing. Now to your question, how to think about the world where central banks, Fed and ECB behave. I will, and then you fortunately narrowed it more, because I will not want to comment how to think about these policies. But your question was very much related to a topic which is important for us, which means what does it mean for the exchange rate development and possible limitation of our policies with the future increases in the interest rates. I think we are fully aware of this risk. This is also part of our model. We built it in. Certainly the ECB policy is in there. And we are aware that should we once start increasing our interest rates, this would be one of the things which we have to watch very, very carefully. I do not think, or I think we collectively do not think anymore, that this issue of overboughtness of the Czech koruna, which was so often raised in 2017, let's say, maybe at the beginning of 2018, does play an important role. I would also say, but my colleagues can complement it, that at least part of these foreign holders maybe left the country at the beginning of the COVID crisis when the Czech koruna depreciated quite substantially, at least part of them. But this is a bit difficult to get the exact data on this. But something to be watched. We are aware of this, and we will see how the exchange rate will react to our potential interest rate increases in future. Do you want to say something more on this?
Maybe one comment. The Czech koruna has traditionally been behaving quite nicely when following the pure interest rate differential and things like that. The abrupt corrections to depreciation or appreciation only happened when the big shock from outside was hitting the economy, and we believe that gradual increasing domestic interest rates will not cause such a shock, because this is a quite understandable story about domestic economy and inflationary pressure. And as Marek emphasized, we are inflation targeting committed central bank.
And let me also maybe add one thing that, in my view, our exchange rate path, it's something a bit, I mean, the appreciation is a bit faster than I think what the markets expect. So, you know, it's also built in that, if I'm not wrong, it has been the case for quite long, at least. I don't know the situation now. So also from this point of view, we should be more or less on the safe side, but we will watch it, of course, very carefully.
Thank you. Thank you.
Thank you. And there is one more question in the pipeline, this time from Jakub Seidler at ING. Jakub?
Hello. Thank you very much for presentation. And I will have two questions. In my first is that Governor Rusnok was relatively confident regarding low uncertainty with COVID, and basically he mentioned that he's 100% sure that rates will go higher. So it seems that there is a reasonable shift in communication compared to March, where risks were highlighted, and now in May it seems that uncertainty declined significantly. So wanted to ask whether you discussed possibility of rate hike even in May. So this is the first question. And the second question is how you discussed the huge discrepancy related in first quarter GDP flash estimate and Czech Central Bank forecast of 1.7% decline in the first quarter, and what does it mean for forecast? Thank you very much.
So thank you, Jakub, for your question. Let me begin with the shift in communication, and if there was a proposal for a hike already now in May. To this part of your question, I will answer that the decision to keep the interest rates unchanged was unanimous. So I think indirectly you get the answer to this part of your question. On the shift in communication, we are aware of this, and I thought I explained it somewhat already before. On the one hand, I mean, before we already, of course, saw the big risk and these big uncertainties linked to the COVID-related development and everything which is linked to it. I will not repeat all these aspects of it. Now, our feeling is, on the one hand, that these risks somewhat diminished with the ongoing vaccination, and also, let's say, with the natural immunity, which, especially in the Czech Republic, but maybe also in other parts of the world and in Europe, we got, which will allow the economy to get open, and which will then lead to better economic and stronger economic activity. So there is a bit more positive view on this part of the story. And the other part of the story is, which I mentioned before as well, that we see also this multiplication of signals which go in inflationary direction. And we have to weigh up all these factors. And of course, we do not want to make a mistake and to move too fast. And we do not exclude the possibility that another bad surprise comes from the side of the pandemic development. That's why we have this scenario. But on the other hand, we are also a central bank which is, we are inflation targeter. We are committed to our inflation target of 2% plus minus 1 percentage point. We are now at the target or very close to it. And the signals are now that we could go up again, maybe even outside the upper end of the target. So we also have to show that we are really committed to our target. So all these factors play a role, and that's why there is this shift in communication when we think that something will have to be done in the second half of the year.
Thank you.
And Jakub, for your second question, we are still living in a very uncertain world, and this huge uncertainty relates not only the economic life itself, but also the way how it is captured by statistical data. Having seen the flash estimate for GDP for the first quarter, we are aware of the fact that there is still economic decline in the first quarter of this year, being envisaged by this flash estimate, but we do not overestimate the initial condition at the beginning of this year. Let's say, take into account 2 or 3 specific factors. The first one is the actual timing of the flash estimate provided by the Czech Statistical Office. As you know, a few years ago, the Czech Statistical Office decided to shorten the time distance between the end of the reference period and the subsequent release of the GDP flash estimate from 45 days to 30 days. So currently the flash estimate is published 30 days, a month ago, a month after the reference period concluded. And when statistical offices in the European Union were moving this way, they were emphasizing that they will be missing the data for the third month of each quarter for which this flash estimate is produced. That's why they, from a big part, they have to estimate or predict the economic activity indicators for the third quarter of for the third month of each quarter for which the statistical office flash estimate is computed. And in this particular case, the third month of the quarter, which had to be replicated or substituted by the estimation, is March this year, which was the most severe month in our COVID history. And the Czech Republic at those times was the deadliest country in the world, unfortunately, because of the spread of the British strain of the coronavirus. And that's why we cannot rule out that the flash estimate will be somewhat revised in the subsequent stages in the next couple of weeks. But if there is still if this estimate is still correct, it doesn't mean a big change of our basic picture because of the 2 things. The first one, and this is very closely related to what I just said before, we reassessed or adjusted the assessment of the cyclical position of the economy during the coronavirus pandemic, and now we attribute the GDP movements more to the fluctuations of the potential output rather than the output gap. And if the economy recovered somewhat better, or the economy was suffering somewhat less compared to our assumptions, this doesn't have much implications for inflationary pressures identified within our core forecasting model. And the second factor is that the better initial condition of the new forecast might lead to less steep increase in the economic activity after the economy is reopened during spring and summer, and that's why the final part of or the final level of the economic activity we will be approaching will be approximately the same, but the profile of this recovery path might be somewhat different from what we expected initially. But let me remind you again that last year this time we were we had forecasts for GDP decline ranging from -5 to -15, and the actual outcome was -4.6. So when facing such a huge amount of uncertainty, I wouldn't overestimate the effects of this flash estimate release. Thank you.
Okay, thank you very much.
Thank you. Jakub, do you have any follow-up questions?
Maybe if I may to ask Mr. Mora, I am aware that the decision was unanimous, so from point of voting it's clear, but I was more interested about the general debate, whether, because Governor Rusnok mentioned that basically the direction of rates is relatively clear now, so that's why the uncertainty about the start of tightening is not so important right now. So I was more asking about some general debate whether might not be even possibility, but from voting it's clear that it was anonymous, but just about the discussion. Thank you.
Discussion was such that it resulted in the outcome as I told you. So the shift, we said about the fact that there was quite a communication shift towards, let's say, more balanced approach to risks and uncertainties of the forecast. It was not such a shift that someone would think that we should start normalizing our policy already now. So let me put it this way.
Thank you very much. Thank you very much.
Okay, thank you. It seems we have run out of questions, so I'm just asking, does anyone else have any further points to raise? If not, let me close this meeting by expressing thanks to all our speakers and also adding thanks to you for joining us. See you in 3 months, hopefully in person. Goodbye for now.
Goodbye.
Thank you. Bye-bye.